The slow deterioration of the monetary system has really caused what I consider to be the fourth turning crisis that we're in now. And as you point out, I think it's accelerating and getting worse. And the solution is the return to sound money.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. I've stated many times on this program that perhaps the easiest macro trend to forecast is that our fiat currencies will continue to lose purchasing power as time goes on. Today's guest explains why and what we can do to protect our wealth from this scourge in his new book, The Big Print: What Happened to America and How Sound Money Will Fix It. We're fortunate to be joined by investor, sound money advocate, and now author, Lawrence Lepard. Lawrence, thanks so much for joining us today.
Hey, thanks, Adam. Please call me Larry. Yeah, it's great to join you, and I'm really looking forward to this.
All right, Larry. Well, look, I think this is your first time on Thoughtful Money, so welcome.
Thank you.
You and I are paths cross from time to time. Last time we were together, I think we were on stage down at Brian London's Great New Orleans event. There was some
Exactly.
fireworks and sparks on that panel, which everybody really enjoyed
That was a
seeing.
lot of fun. Yeah, my Bitcoin tie, my non-existent Bitcoin tie.
Look, you've just ended up publishing this really impressive book, The Big
Thank
Print.
you.
We're going to tell people where they can go find it. But I want to walk through its core insights today. And basically, as I read it, The Big Print is a treatise on how our current fiat monetary system, by design, abuse, or mismanagement, will continue to drain away the purchasing power of our money. And it's clear from the book that you think the pace of that's only going to get worse. So
Right.
let's start there. Why? Explain for folks.
Yeah. Okay, great. Well, it's a long story, and the book lays it out. But there's been a trend, really since the founding of the country, but it's accelerated more recently, toward those in the positions of power in both the government and the monetary system have continually kind of tilted the game board or the playing board in their favor. And this is what's created, the massive wealth inequality that we now have, and the unfairness in our system. And it was, each step along the way seemed minor at the time, perhaps, or maybe major at the time, and maybe minor, somewhat minor in the long run. But, I mean, it started with the War of 1812, and then greenbacks in the Civil War, and then, financing World War One, the creation of the Fed, the financing of World War One, and then, yield curve control with World War II. And then probably the biggest event, the biggest monetary event that we faced was going off the gold standard when Nixon broke the link, the international exchange standard link to gold, post Bretton Woods. And, all of these things have been inflationary, and inflation benefits the people at the top of the system who can borrow more cheaply and know how to game the system. And it harms the common citizen, the working person who does not have the financial engineering skills to borrow money cheap and invest it in yielding assets. And this is what's led to just this enormous break in our society of, the haves and the have-nots. And there's a great chart in the book we go to if you like, where, the top 1% of the population now controls 92% of the wealth, and that grows every year. And the bottom 50% of the population controls 15% of the wealth, and that's stagnant. And this is just really an unfair system. I mean, the Constitution was written to try and, guarantee and that everyone would have the fruits of their labor, and there would be a fair governmental system and a fair system. And it started off with a great premise, and for many, many years we held on to that. But the slow deterioration of the monetary system has really caused what I consider to be the fourth turning crisis that we're in now. And as you point out, I think it's accelerating and getting worse. And the solution is the return to sound money. I mean, one thing I want to emphasize, all those things in the book is divided into two sections. The first half is the problem. The second is the solution. The problem is kind of depressing, and I don't want to be a doomster or a depressing kind of guy, because I'm a very optimistic guy about what's going on in the world and how technology and other things are going to make the world a better place. But you can't address the problem if you don't understand the problem. And the problem is kind of depressing. But part two of the book is the solution. And there's a great solution. There are a lot of technical things that are happening that I think are going to take us to a much better world. But, there's going to be a rocky transition between now and then. And I've been watching all of your interviews, Adam. I know you're very much aware of this, and as are all of your excellent guests. So, that transition is probably something we should talk about, but I'll let you go from here.
All right. Well, yes, and I very much appreciated how the book was divided into, problem definition, helping us understand it, and then, okay, let's just not wallow in the depressiveness of that. What can we actually do about it? And you've got an awful lot of the book dedicated to the solutions, which we're going to get to in a bit. But let's continue fleshing out the problem a little bit more. We'll then talk about kind of the turbulence of the transition, and then really dig into where you see the optimism here in the story. Real quick though, if we can, again, you mentioned at the end of your great explanation there that you think this trend of purchasing power diminishment and expansion of the wealth gap is likely to accelerate. What are you expecting to be the catalysts or the triggers for that acceleration?
Yeah, that's a
Is it
great.
just the exponential trends of
Yeah,
money and
some
how
of
things
some of
go?
it is just the simple math, that we're growing the debt faster than we're growing the GDP, and in spite of Doge's best efforts, I don't think they can slow it down that much. Some of it is where we are in the entire cycle. I mean, I think one chart in the book that's very telling is the U.S. federal government interest expense chart, where, it's just kind of gone almost vertical. And so these kinds of trends are typical in emerging or sovereign debt crisis, emerging market and sovereign debt crises. And of course, we are not an emerging market. We are the world's reserve currency. But if we behave in a way that is similar to all these other emerging market crises, we're likely to have the same result. One of my favorite charts in the book is the one by Hirschman, where he profiles 11 countries or so roughly that have had debt to GDP of 130%, and how they've all led to either a depression or high inflation, arguably even hyperinflation. And so we are now at 120, 125% debt to GDP. So we're teetering right on the cusp of a place where all other countries who've done this have run into trouble. And I think we're kind of seeing that. There's some evidence just in the markets. If you look at them, I mean, look at the relentless bid for gold, just hitting record highs. I mean, I was surprised when it went through 2070. I mean, not surprised, I expected it, but with authority, and everybody thought, well, it went to 2,300, it'll come back down. Well, it's gone to 3,100 plus, and it hasn't stopped. And to me, that's a signal that we're in it. We are really in, an accelerating phase of fiat debasement.
Okay, and so on that point, I asked somebody else on this channel relatively recently if they thought that gold's very strong run here in the near term was due to the world kind of waking up to some of these larger issues around our debt situation and the future of fiat money. And this person who shall be nameless for this conversation, but I think most people watching probably know who was, said, no, it's right now it's just short-term capital flows and uncertainty and actually sort of speculation. Like people are jumping on the trade now, and this is a short-term speculative chase, and it's overbought. And absolutely, gold could correct her in the short term. I mean,
Oh,
nothing
no
goes in a
question.
straight line, no way. No question. But it sounds like you actually think somewhat differently, that you think this is at least part of the
Yeah,
investor community
I
waking up
think
to the
it's
fact.
yeah, I think it's a fundamental indicator. I mean, you see it in other clues as well, and kind of everybody's asking for their gold back, which suggests that there's maybe a crack in the paper gold market. There's been a lot of claims sold against more gold than there've been more claims sold against gold than gold that actually exists. And it also, the other sound reform, which we'll have to talk about, is Bitcoin. Now it's come down a bit because it's been somewhat correlated with the NASDAQ, but it hit a record high of 106 or 7, within the last 30, 40 days. So these are two forms of sound money, and you compare these to what's happened, in the book. There are actually charts on this where it shows them compared to the bond. The US government bond used to be the base layer of money. It was the soundest thing you could own. It was, AAA credit rated, and you had no worry that you were going to get paid back and paid back in real purchasing terms with it. And compared to the US bond, gold is up since 2020 when the COVID examples broke out. Gold's up 220 odd percent, and Bitcoin is up, 2000%. So, to me, that says sovereign debt crisis. Those are markets talking in a way that indicate to me that we have sovereign debt crisis. I mean, gold was up 50% over the last 12 months. That has almost never happened. The last time that happened was in the 70s, where gold was about to go from, 35 to, 800. And so I think there are bigger forces at work. And it's interesting to me. I mean, that, that other guest, I'm sure, look, traditionally when gold's very extended compared to its 200-day moving average. And so generally when that's the case, the correct trade is you short it, right? It's going to come back to its 200-day moving average. But I think that what's going on here, there are different forces at work in terms of, the understanding that this problem is really, the world is waking up to this problem. I mean, those of us who've been in the sound money community have known it for years and years. We've been crying in the wilderness, and everyone says we're the boy who cried wolf, and we have been. But I think maybe the wolf is actually really here. I don't know. I mean, it could correct a bit for sure.
All right. Well, look, there's a saying from Ben Hunt of Epsilon Theory. He talks a lot about when private knowledge becomes common knowledge, where it's kind
Yes.
of a phase change, right? And it sounds like you think, not no guarantees, you're not entirely sure, but you're suspicious that we may now be at the phase change where the private knowledge around the vulnerabilities of our currency are now becoming a common knowledge, and people are starting to take action commensurate with
I
that.
think that's absolutely right. I think that's what's going on, Adam. That's a very good way to describe it.
Okay. All right. Well, look, I want to stay in the problem section for a little bit longer, just to make some things clear for folks before we get to the solutions. And one, I just want to start by acknowledging what I believe you wrote this in the introduction, but it was sort of, your early genesis for why you ended up writing this book. And you tell a great story about being at a reunion for Harvard Business School, of which you were a graduate. Um, and it was what it was Greenspan,
No, Greenspan was Bernanke, Geithner, and Paulson, Hank
sorry,
Paulson,
Bernanke, Geithner, and
and,
Paulson.
oh, and
Okay.
Larry Summers too. Yeah.
Wow. All right. So an august group of the gentlemen who quote unquote saved the world, during
Yes,
the global
exactly.
financial crisis. And look, let me just tee it up, and I'll let you explain any way you
Okay.
like. But basically, they were there, sort of showering their generosity on the Harvard alumni there, saying, "Oh, we're going to explain to you why what we did was so wonderful, and aren't we so great?" And I guess that they said, "Look, is there anybody here that sort of disagreed with what we did?" And it sounded like it was crickets until one person in the audience raised their hand. And who was that
Yeah,
person?
and I was that crazy one person. As Preston Pysh said to me, I was reading that and I'm thinking to myself, "Oh, Larry, please don't do it. Please don't do it." And by the way, you don't have to buy the book to hear this story. If you go on Amazon, this is in the preview, so you can hear it. And yeah, they were taking a victory lap, and they were there to pat themselves on the back about how they saved the economy. And I heard all of that, and I just wanted to puke. I mean, I have a very strong, as you know, Adam. I don't lack for opinions, right? Many times I'm wrong, but I don't lack for opinions. And I just couldn't let it stand. And so I raised my hand and I said, I disagree. I think what you guys did was wrong. And by the way, I think they know what they did was wrong, but that's a different matter and talked about in the book. I have to say, Adam, there are times I regret having done that. I mean, what I said was not well received. I got some very nasty comments in the coffee meeting afterwards. And, I just had to call them as I saw them. I will say I did have a couple of people sheepishly come up to me and say, "Man, that tech took guts. You're right." So a few people acknowledged my point of view, but most of them thought that I had just taken a shot at their heroes. And that persists to this day. In a recent meeting down here, I criticized Bernanke and a guy exploded at me. So, my view, and I think the book lays out a pretty strong case for it, is that the Federal Reserve has not been a good thing for this country. But obviously, other people share a different view.
Well, okay, that's a good segue into my next question then, where you do spend a fair amount of time in the book talking about, we'll call the sins of the Federal Reserve, or really
Yeah.
central banking in general, because these problems aren't unique to the
No,
US.
right.
Um, uh, maybe I'll give you just sort of a minute to list off the greatest hits of why, what you think the biggest sins of the Federal Reserve are, but more importantly, please also discuss the contribution of fiscal policy to this problem as
Well,
well, because it's
yeah, I
not
mean,
just a monetary issue, right?
no, it's not just the monetary. And what's kind of amazing to me is, I mean, even guys like Powell have said, "Hey, this fiscal path is unsustainable." And so my reaction to that is like, "Okay, dude, well, if that's the case, then why are you enabling it?" The obviously it's the spending that causes. I mean, the fiscal and the monetary go hand in hand. I mean, the government, the Congress, the people who wage the wars, spend the money, run the deficits. They're the drug addict, and the Fed is the dealer, right? They have the low cost drugs that they can use to print the money to pay for all these things. And so they do go hand in hand, and it's the fact that we are overspending that causes the Fed to have to do what they do. But this isn't an old story. I mean, this happened in World War One. The Fed was created in 1913, and 3 years later, when the war broke out, they started selling bonds for 3.5%. Liberty bonds were 3.5%, and the Fed was lending money to the banks at 3%. The banks were making a 50 basis point free spread. So, for a long, long time, government and Federal Reserve have been gone hand in hand, and the government gets to spend what it wants, and the Federal Reserve gets to create money. And then, of course, when they're done, they can become advisors to PINCO, or like Janet Yellen, they can get 7 million in speaking fees. So it's a corrupt system that, leaves all of us paying the bill, because that money that they spend is what makes our groceries so expensive and makes our gasoline so expensive. I mean, in the COVID example, they printed 40%, they grew M2 40% in 2 years, and we all got 40% higher prices and devalued savings.
So I just want to, probably most viewers get this, but for those that don't, when you talk about the Fed being the enabler there of the fiscal profligacy, it's that basically to spend, the government, the fiscal side, has to go out and sell bonds. And the money they get from those bonds, they can then go spend. In a lot of cases, the buyer of those bonds is the Federal Reserve. And in many cases, the Federal Reserve is buying those bonds by printing money out of thin air to buy them. So that's the way in which the Fed enables the fiscal side of things.
Exactly. Very good explanation.
Okay. Now, obviously, we're at a point post-COVID where the fiscal spending has just ramped up to 11, right? We're spending it as a percentage of GDP. We're spending at levels that we've never spent at outside of major crises like a world war, right? But somehow that's become business as usual.
Correct.
Right. All right.
Yeah,
Well,
I mean, that's a problem. I mean, they never backed it off, and Doge is helping. Don't get me wrong, and I support Doge. I support what they're trying to do, but as I think some of your other guests have explained, you well know, 80% of it's very hard to touch. Social Security, Medicare, Medicaid, interest and defense are 80% of the budget. So without really taking a machete to those things, which is politically very difficult, we are going to continue to run big deficits.
Okay, well, I'm going to ask you in a little bit more detail in a moment about your thoughts on the economic policy of the new administration. Obviously, Doge being one of those, but a big part of your solutions, part of your book, also talks about policy reform you'd like to see that would help, and so we'll dig into that too. Real quick, there are two things that you end your problem part of the book on that I think are interesting. One is Stein's law, right? Which I think is kind of like the reason you wrote this book. And also, since you mentioned Doge and whatnot, it seems to be the reason that these very impressive people like Scott Bessent, like Elon Musk, like a lot of the CEOs that have joined the Doge team, who definitely have better, have really good alternatives, right? They don't have to go into public service. They can go be gazillionaires, on their own.
Right.
But they have looked at the current system and said, oh my gosh, if this just keeps going the way it's going, it's going to end in disaster. And that's kind of where we get the Stein's law, right?
Yes, correct. Yeah.
So for folks that don't know what it is, can you sum it up?
Oh, yes. I'm sorry. So Stein's law is, if somebody, Herbert Stein was an economic advisor to Richard Nixon, and he coined a law that kind of everyone picked up on. It's called, if something cannot go on forever, it will end. It's a rather simple law, and it's almost a tautology, but it's true that if you continue to spend, I mean, the U.S. government is very much like the household that spends more than they earn, and they make it up by taking out a new credit card, and they run the credit card up to its max, and then they make the minimum payments on all the prior cards, and when they spend more again, they try and get another credit card, and at some point the markets are going to pull the card. There's not going to be another credit card to be gotten, and that's when Stein's law becomes real, where eventually everyone knows that the only way they can keep spending the money they're doing is to print money through QE and other mechanisms. And so eventually the confidence in the currency gets lost. And so, and that's called Gresham's law. And I think there are those of us who are very much aware of this risk, myself and other hard money proponents. And by the way, others are joining us, like, very high profile, smart investors like Ray Dalio, Paul Tudor Jones, et cetera. I mean, we're not the only people who've seen this, but when this becomes common knowledge that they can't stop spending money and they won't stop spending money, and that they will continue to print, and the amount they print will get bigger with each iteration, which it has done, by the way. I mean, the book's called The Big Print because I think another one's coming, but we had two. We had one in 2020 and we had one in 2008. The first one in 08 printed, 3 trillion over 5, 6 years. The next one printed 5 trillion over 18 months. And I think the next one's going to be bigger still. So my sense is that as the market, as you described earlier, this common knowledge thing, as it becomes greater and greater common knowledge that there is no solution to this problem other than printing money, people will naturally abandon the money, and they just won't use it, or they'll hold it for very short periods of time, realizing that it is always continually being debased. And you might ask how this will manifest itself. It'll manifest itself in the bond market. The bond market is the sucker at the table. Anyone who wants to hold a long-term obligation to the United States government, that's a losing deal, because there's almost, in my mind, almost mathematical certainty that inflation will exceed the return on those bonds over the next 10 to 20 years. And so as the bond market gets, cranky about that, they're going to start selling bonds. Rates are going to go up. That rate going up creates the doom loop, the death doom loop, which is, more interest expense leads to more bonds into the same size market, leads to higher interest expense. You can see it's a reflexively negative cycle. And as that occurs, the government is forced to print money. They're forced to go back to yield curve control, and QE, where they buy the bonds and they print the money to buy the bonds. And with the next one, I mean, with each cycle, we've all gotten smarter about what their game is. And I think with the next cycle, a large group of people are going to get a lot smarter. And the bond market might in turn to the Fed and say, sold to you. And if that happens, the bond market is $37 trillion. The Fed balance sheet is $7 trillion. So if the Fed had to print $37 trillion to buy the entire US bond market, that would not be good from an inflation point of view.
No, not at all. And so I had a bunch of questions to ask that you just actually ticked off there. But no, so we've already seen some early signs of, we could call cracks, right? Not saying the whole system's falling apart tomorrow, but we've seen, we saw for a while 10-year yields go up despite the Fed trying to bring down rates on the short end of the curve. We've definitely seen foreign buyers over the past couple of years, reduce their appetite for treasuries, right? We have gotten to the point where we've seen a dramatic expansion in our debt interest service cost on the budget. It's now greater than our defense spending, right? So we are seeing early warning signs. One of the things I just want to note here is this is, well, I think in general, maybe in the long scope of history, we'll look back and this will look like an accelerating decline. When you're living in it, it's not going to be a straight line. And, to a certain extent, what's going on here is going on in most of the other major nations around the world too. And so, the US's at least perceived position is the best horse in the glue factory, the cleanest shirt in the laundry. Like at times that will still cause capital to flow in here, not because the US is so great, it's just less bad compared to what some of these other countries are doing. The reason why I bring this out is just to caution people, like, they can read a lot of the problems and say, oh my God, this thing's going down, and they can position for the end game. But you can get wiped out a lot during the way.
Absolutely, absolutely. That's a very important point to make. And as you know, I have strong opinions, and as a result of that, sometimes I'm wrong. And I thought it was all blowing up in 08, and this thing could get dragged on much longer than I think. And these currency events tend to be volatile events. There's a chart in the book on the Weimar event, and shows how gold was the right thing to hold in a hyperinflationary event in Germany from 1917 to 1923. But there were periods of time where gold performed very poorly in that time frame. So these things are chaotic, and it is tough. And one has to know what one owns and why one owns it. I personally, and one has to take a long-term time view. And I have a very long-term time view. And as your other guest said, I mean, gold could easily, I mean, in a disruptive credit event where all correlations go to 1, like what we had in March of 2020, gold could fall from 3,100 to 2,400 in a heartbeat. It could absolutely fall in a heartbeat. And Bitcoin could go from, 86 back down to 50 easily, in my view. But, I think the response to that kind of a credit event would be what I titled the book, the
The
government
big print,
by
yeah.
definition cannot avoid printing. And when they come back in with the bazookas, gold would then go to 4,000 and Bitcoin would then go to 100,000 plus again. So, it's sad, Adam, that we have a system that forces us all to be speculators based on what 12 people sitting at a Federal Reserve Board in Washington, D.C. decide, right? I mean, it's really sad. And to me, that's a perfect indicator of just how broken this whole damn thing is. That
You
we
know,
have
I have said that exact
yes,
same sentence so often over the past 10 years that rather than just pick the best companies in the most
right,
promising industries and try to invest the old Benjamin Graham way,
right.
instead we're all speculators trying to guess what these 12 people are going to decide
It's
to do
it's
around the
it's
table.
just it's absolutely nuts. This is not what I grew up in. I grew up investing in technology companies. It was really neat because they grew. I invested in Dell Computer very early. It's a fabulous business, right? I mean, but that, sadly, there's less of that and more of this.
Well, I would posit it's actually less so. Um, I mean, really, starting with Greenspan, we really started to have to really speculate what these folks were going to say around the FOMC table.
Exactly.
But I think coming out of COVID, we now really have to speculate what that table is going to do in parallel with what Congress is going to do,
That's right.
because I suspect the next big print, it's not just fiscal rescue. Sorry, it's not just
No.
monetary rescue. It's going to be
Yeah,
fiscal
well,
rescue too,
well,
because that
COVID.
playbook's now been established, right?
Yeah, so COVID showed us this. I mean, the stimmy checks and the PPP, I mean, this is a whole new level, right? And so you can imagine that the next big problem, people are going to be hurting and they're going to demand, they've seen stimmies, they know what that's all about, and they're going to say, hey, I want some of that, and so and universal basic income will clearly be on the table, right? And so, I mean, and if the MMT people ever get in control, look out, right? Because their view is the spending doesn't matter. They need to spend whatever it takes to keep the economy going. And of course, those of us who understand, income statements and balance sheets, we all realize that that's a fallacy.
Right. So, okay. So in the near term, it's not going to be a straight line. There's going to be
Yep.
dips and zigs and zags and all that stuff. But in the long run, for all the reasons that you lay out in the book and that you've laid out so far in this discussion,
Yeah.
you think it's a near certitude, and that's where we get to the meme of nothing stops this train, right?
Yeah, yeah, it's Lynn's meme, Lynn Alden's meme. She's brilliant, and her book is highly recommended. Yeah, I mean, sadly, the math is really, really unfavorable at this stage in time. I mean, it's kind of like, anybody who plays with compound functions understands that eventually you keep compounding and things and they get really, really big, really, really quickly. And, the debt has gone up very, very rapidly as compared to the GDP, which has not grown. And this is why we have the problem. And yeah, I mean, like Doge, I applaud Doge. I totally applaud it. But we are very deeply in this crisis, and there is a painless way out or a less painful way out. But if we know politics and how politics works, they probably won't take it just because not everyone understands the problem and not everyone's forward thinking. But what they should do is they should do a debt devaluation and a reset. But I don't think anybody, I think Besant probably understands that, but I don't think they have the political cover to do it. It's going to take a crisis, unfortunately, for that to probably happen.
Okay, so we're now at the point where we're going to transition from talking about the problem to talking about the solutions.
Yeah.
And I appreciate your catch, because I was gonna talk to you about it. You said initially, well, there's a painless way to do it. Well, actually, there's a less painful way to do it. There is no painless solution on the table at
No,
this point, right? Yeah.
no, there's just, look, the debt is bad and debtors are going to get hurt badly. Okay. And savers are going to get hurt. So, and sadly, that's unavoidable. I mean, we've driven ourselves into this bad position and something's got to give.
Okay, so you in your solutions second half of the book, you go through some very specific things you think that would be helpful, but what they all have in common is sound money. So if we
Yes.
can you just start by defining what you see as sound money?
Absolutely. That's a great question. It's very important. And so sound money's been around a long time. Sound money is money that does not get diluted. It's money that can be relied upon to hold its value over time and space. And pre-Bitcoin, gold emerged. Humanity chose gold as sound money because there's a limited amount of it geologically on the planet, and the supply only grows by 1.7% a year. And sound money's been known for a very, very long time. And, it's in the Bible. I mean, honest weights and measures. I mean, people generally speaking want to cheat on monetary affairs if they can. Everyone's got a little larceny in them. And so, the authors of the Bible said, thou shalt not, deal in unsound weight and measures, which is really unsound money. And the founders of the U.S. Constitution saw gold and silver as sound money. They recognized the danger of hyperinflation as Continental had hyperinflated, and it was in the Constitution, Article 1, Section 8. Only gold and silver will be sound money.
It
Of course,
still is in the Constitution,
it
but for
still is in
some
the
reason we've
Constitution. Of
moved
course,
on from it. Yeah.
we've drifted away from it, like so many things. Sadly, in the Constitution, we don't pay attention to it anymore. But so sound money is money that cannot be diluted, and historically, it has been gold and silver for 5,000 plus years. More recently, Bitcoin has emerged as a sound form of sound money. I call it digital gold. I think gold is analog sound money, Bitcoin is digital sound money. But set that aside for a moment. And sound money is really kind of a moral issue, because if governments by definition deal in unsound money, what they do is they take pieces of paper and they print something on it, and they say this has money because we say it has money. You have to pay your taxes in this, and we're declaring this to be money. And so what they're doing is they're reaping without having sown. There was no proof of work to do that money. They just printed it. And so by definition, the history shows that governments will abuse that privilege. And it starts with the Chinese in the 13th century. I mean, so there have been plenty of governments that have clipped coins, printed money, whatever, used signorage to take advantage of people. And the US government is just the last in a long string of them. And it was somewhat restrained when we were on a gold standard, and we had a gold exchange standard until 1971. But truly, one of my favorite charts in the book is the chart that shows inflation from 1800 to present, where, basically in 71, inflation just takes off and doesn't stop. And so when we got off the gold standard, we entered the world of fiat money as being the only form of money, or the most popular form of money. And it's been a problem. And the problem has grown progressively worse. And in my opinion, we're now very close to the end game, where the pain is going to become so large that a large group of the population is going to say, you know what, this is just too painful. We need to return to sound money. And we will. And that's the really hopeful part, that human beings are smart and human beings understand history. And eventually we'll all get to that point, and we'll be back on a sound money standard, and the world will be quite good. But,
So
we got to go through the transition, right?
you get to go through the transition, and sounds like, we'll be pulled through it kicking and screaming. It's not something
Some
we're
will.
going to
Yeah, for
wholeheartedly
sure.
embrace.
Yeah.
And yeah, I'm reminded of the Winston Churchill quote about Americans,
Yep.
which is he loves them because they'll always do the right thing after they've exhausted every other potential option. Sounds
I
like,
think
well,
that's exactly right.
yeah. Okay, so the point being is you know, just like the person that has the heart attack and says, okay, I really got to start taking my health seriously now. The important reforms probably won't happen until the pain of maintaining the status quo exceeds the pain of change, right? So in other words, it's prepare for pain is what we should mentally prepare for here, right?
Yeah, I mean, I hate to say that, but I think that's probably right.
Okay.
I'd like to think there's a painless way to get through it, but yeah, that's correct.
All right. And it sounds like you think that it probably be painful for everybody, but the people who are really going to be painful are going to feel the pain, are going to be the debt holders, because a lot of
Yes.
that debt is going to be, I don't know whether it's going to be
Diluted
defaulted
away in
on or wiped
value.
out or whatever.
Yeah. Well, and older people and savers, anybody who's got wealth denominated in the old currency is going to lose value relative to things. I mean, as I say, you want to own things the government can't print. And the government can print money, print bonds, whatever. Government can't print houses, can't print gold, can't print Bitcoin.
Okay,
And I
so
think
hard assets, like
hard
tangible hard
assets.
assets,
I think
land.
on a relative basis, these things are going to perform very, very well in the next 10 years.
Okay. So you start off your solution section by saying embrace deflation.
Yes.
Yeah. And it's interesting because we have a system that it kind of tries to convince us that inflation is a good thing unless you have too much of it. But the Fed has
Uh,
a 2% inflation target, right? We've
yeah.
been told,
Yeah.
hey, you actually want this. It's not a bug, it's a feature.
Yeah.
But I think most people scratch their heads and say, well, I wouldn't really mind if prices went down, right?
Right, exactly. Yeah, no, Keynesians have really poisoned the water or gaslit all of us into thinking, the Great Depression and the deflation that occurred during that time period has been used by the Keynesian government and economic people to convince us all that we actually need some inflation or else we'll fall into a depression again. And that couldn't be a bigger lie. That's an enormous lie. We do not need deflation, or we do not need inflation. We had deflation throughout the 19th century and things were fantastic. Living standards went up enormously. And so, the Keynesians, and they've done this for their own self-interest. I mean, it serves them, at the Federal Reserve, and it serves the people in government to have an inflationary system because they can do the things they want to do.
Right, because it helps make the debt,
Right. It
it
helps make the
retards the
debt
pain of the debt.
palatable. It,
Yeah.
it helps let them spend more so they can get reelected. It helps their wealthy constituents who know how to game the system. I mean, the quintillionaires who can borrow cheaply and invest in assets that provide yield. So yeah, we've been fed a lie. I mean, and one of the, I don't know if you read the presidential speech, which is the solution, but I think one of the things, the first things that American leaders have to do is come clean and just say guys, we bought the wrong model. Inflation and growth is not really what we need. What we need is productivity and efficiency. I mean, growth taken to the extreme and we're going to outstrip the supply of the planet and everything's going to collapse. Well, we've got to figure out how to do more with less. And the way that you do more with less is you properly price capital. And you properly price capital when you balance savings supply of capital against investment demand for capital. And we've got these 12 people sitting at the Federal Reserve building in DC, and they set the cost of capital in Volcker's case at 20%, which nearly bankrupted my dad, or in Bernanke's case at 0%, which gave everybody who had capital an amazing subsidy and ability to borrow and go and get rich by levering up and buying productive assets. But all of that caused inflation for the rest of us.
Right,
And
and
so
destroyed savers and
destroyed
priced everything
savings. I
out of
mean,
the risk of younger
yeah, I
generations.
mean,
Yeah.
and there's a talk in the book about how savings really is what drives increased living standards. I mean, you save your seed corn and you plant it, and therefore you get more corn. And savings is considered stupid and antiquated and quaint. I mean, everybody now lives on how much debt can I get in and how much assets, what assets can I buy, and therefore how much carry can I get? And that's just all wrong. It's economics turned on its head. And again, I wrote the book because I saw everyone, I'm looking at the entire country, and there's a great meme on Twitter where it's like, there's a huge group of people and there's one guy standing there and the one guy saying, "You're all wrong." And I feel like I'm that one guy. It's just like, you guys all think we got to live in this inflationary system. And it's like, no, you're wrong. We don't. We've drifted away from core principles of economics, which are you save and invest, and that creates efficiency. And efficiency brings good beings. I mean, we would all be much better off if we did not live in a Keynesian world. I mean, our living standards would be higher universally, in spite of how great they are because of all the technology we've got. But a lot of that technological efficiency gains have been eaten away by inflation and then wealth transferred to the top 1%.
All right. Well, look, I'm gonna start speaking a little quickly here, Larry, only because we've
We
got
can go,
about.
Adam, we can go over if we need to. So
All right. Okay. Well, then thanks. I'll try not to abuse that, but thanks. Okay. So you talked about the president's speech. So Larry, we make you, temporary emperor of America here.
yeah.
What policies do you prioritize highest? And then maybe in your answer too, if there's any policies that the current administration is doing that you think are good or particularly good or particularly bad, just call those out too.
Yeah, well, this is really hard, and I'm going to catch some flack for a lot of this, but I think I start off by saying, guys, we're in a broken Keynesian model and it's wrong. First thing we need to do is we need to have all currencies compete on a fair and level playing field. So we need to have gold, silver, and Bitcoin all become legal tender. They're not investments, they're actually forms of money. So if you own gold and it goes up in value, you don't pay tax on it. You own silver, it goes up in value, you don't pay tax. You own Bitcoin, it goes up in value, you don't pay tax. The next thing we need to do is we need to shut down the Federal Reserve, just plain shut it down. We're no longer going to bail out banks and bail out the system. And the third thing we need to do is we need to shut down the FDIC. We've got the FDIC has less than 1% of the bank deposits outstanding in its reserve fund. And so it's really a joke. It can't cover all this. And it's these bailouts that lead to printing money that leads to inflation. if we did the steps we need to make it, or if we don't shut down the Federal Reserve, we need to make it illegal for the Federal Reserve to buy bonds and just let the interest rates go to their natural level. These things are relatively radical, and there might be some serious pain that comes out of these things occurring. But eventually, the unproductive businesses, the overly risky banks, et cetera, they would collapse. And through that, we would see new growth of sound money-based businesses, people, institutions, et cetera. That's kind of the overarching thing. Related to that, we need to balance the federal budget. We need to, in my view, I would put in term limits, and I would probably publicly fund elections and try and get all the money out of politics. I actually might pay politicians more and guarantee them a lifetime income in exchange for their agreeing not to go to work for the industry that they were regulating, so that they couldn't basically regulate in an industry's favor and then get paid a bribe afterwards. A lot of things like that. Those are, I mean, and there are more ideas. I just was recently at a speech given by David Stockman, and it was really quite brilliant, actually. He talked about one of the things he could do is, I mean, we could cut down the military footprint. I mean, one of the most beautiful things about returning to a sound money system, Adam, in my view, and another reason I wrote the book, is that this fiat money is war enabling. I mean, if you went to the population and said, guys, we're going to have a big war and we're going to tax you 60% to have it, population would say, what the hell are you doing? We're not doing that. I don't want to pay 60% tax, and we're not having a war. But in turn, what they do is they say, we're going to have a big war, and we're not going to tax you for it. But guess what? We're going to print the money for it, and you're going to pay higher prices. And so my sense is that we would have a more peaceful world in a sound money environment.
All right. Well, those are all, I totally understand the logic behind each one of those. I'm sure you're probably going to get a couple of folks watching this who would like to vote you as America's
I'm
emperor.
not running.
Yeah. Now you mentioned just switching to the current administration, which has a very, new set of policies economically versus previous
Yeah.
administrations. Sounds like Doge, you're fairly in favor of. How about the rest of what's going on right now?
Yeah. So, well, he's a disruptor, and I'm not sure he entirely understands what he's doing. And I think in general, they're naive about what's going to happen here. This tariff thing is very disruptive. I don't think it's a bad idea. The government was financed by tariffs pre-1913. And I don't think it's a bad idea to charge other people for having access to our large consumer market. But I think it's a rather naive idea. I mean, I think Scott Bessent's a good guy. I think he's a smart guy. But I'll be quite frank, I don't think he has I don't think he has a full understanding of how disruptive what he's talking about is going to be. And so therefore, I think the stock market is sitting on a very, very thin layer of ice and about to crack. And so, I think they have to do some of the things they're doing, and I'm glad to see them doing them. And yet, I think I think there's a recency bias that nothing bad can happen in the market, nothing bad can happen in the world, that I think is going to be shattered in the next couple of years. I think that these tariffs are going to be massively inflationary. They're going to lead to, trade wars, and he talks about doing them and backing off and so on and so forth. Sadly, he got handed a pile of shit, and I don't know, and I think he's leaning in the right direction on absolutely everything, but I'm not really sure he can pull a rabbit out of his hat. I think that, in 4 years, we're going to have more inflation. We might have a stock market that's down. The deficits might still be large, and as much as he's going to try and blame it on the hand that Biden dealt to him, my guess is in 4 years, people are going to be worse off, and they're going to say, all right, give me Team Blue. And, God knows what happens there. We're going to have Stephanie Kelton as our Treasury Secretary, and Andrew Yang as our Vice President, with universal basic income and stimmy checks coming out of AOC and blah, 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 right? That's the problem, Adam. We're in a fourth turning where things are really broken. And in my view, this is going to be really chaotic. And so people need to think outside the box in terms of how to protect themselves from chaos. One of the biggest, and I know you're going to have your excellent financial advisors, Mike Preston and John Landra, on after me. I think they share my views on this. One of the biggest things where I think a lot of people are sleepwalking into trouble is there are a lot of boomers I know who have a lot of their wealth in the stock market.
Mhm.
And there's some
Yeah,
charts
in stocks. I
in
mean, not
stocks. Yeah,
yeah.
yeah. And if you look in the book, there are a couple of really great charts from John Hussman. I mean, this is an extremely pricey stock market. I think there is a lot more downside risk in the stock market than the average stock market participant perceives. I mean, using historical metrics, and I think they have validity, John Hussman calculates the market could go down 65% and would only be within the fair value range.
Hmm.
So, I mean, apart from, I recommend to my clients that they have some sound money, which would be Bitcoin and gold. But I also recommend, and I have a harder time with this one, that they lighten up on stocks. And stocks have been so good to them. They've been up 20% a year, so many years compounded, that they just refuse to do it. And I think that's going to be an area, there's, in my view, we're in an everything bubble, right? And it was driven by the ZERP that took place from 08 to 15 and from 19 to 22. And stock prices are just nuts. And so when this bubble bursts, I've lived through two bursting bubbles, 08 and 2000. They don't burst gradually. They burst and go down quite a bit. I mean, the Nasdaq went down 80%. The S&P went down 50% in that case, and in 2008, the S&P went down 50% as well. So, I think people should ask themselves, am I comfortable holding the stocks I hold, knowing that there's a chance they could go down 40 or 50%? And I think if you think about that, that's probably, and the book talks about this. I mean, that's one of my stronger pieces of advice is people should be aware of that risk.
All right. So the stocks, you're worried for the reasons you just mentioned. You think folks should own some sound money, gold, Bitcoin. Um, you mentioned earlier that you think in the long run, those who own bonds are going to take some pretty big losses here. In the immediate term, I'm going to guess, just given how you've described your outlook, at least in the near term, you probably think T-bills are not a bad place to park in the short
T-bills are
term.
fine. Really short-term stuff. I mean, I have some cash in T-bills. I mean, 3-4% with, no risk of principal repayment. That's fine. But I mean, I don't go durations of more than 6 or 9 months, you know.
Yeah.
So
Now, with a big print, so let's say the markets do suffer from here, and we get to a point where the big print happens, right?
yeah.
We got to come to the rescue. Even though you're a big sound money guy, when the rescue happens, are you going to put some money in stocks and things like that that historically benefit from this juicing?
Um, Hard to say. I mean, I think I'll have to look at where they're at and what's happened and how far down they've gone beforehand. I mean, I think the easiest bets will be in gold and Bitcoin. I think they are the most asymmetric bets that will benefit from that printing. I mean, there's some
Okay,
idea.
so you would
Yeah,
stay in the safety of, hey, I'm in sound money and it's going to do really well anyways, so
on a
why take on
relative
additional
basis. I
risk?
mean,
Yeah.
there'll be commodity stocks, there'll be gold mining stocks. I manage a fund with gold mining stocks in it. I mean, I've seen people say, hey, Brazil's really cheap. You can buy commodity stocks in Brazil for 4 times earnings and you'll get the ride on the US dollar depreciating. I mean, one of the other things that's got to happen, Adam, is the dollar's got to go down. The dollar is very, we are the cleanest dirty shirt, but we really, if you look at our fiscal condition, it's actually pretty dirty.
Hmm.
And so I think we're going to have a lower dollar, relative to other countries in the future.
Okay. All right. Well, look, as we start to wrap up here, Larry, so I've had enough people on this program, for a good long while talking about gold and the
Yeah.
fundamental reasons to own it and all that stuff, and even the technical reasons to own it. Um, I've had less Bitcoiners on, so let you make the case here for Bitcoin, and then I want to
Yeah,
ask you
please.
one sort of philosophical question about it.
Absolutely. Please do. So Bitcoin is, a lot of people are skeptical about Bitcoin, understandably so. Crypto is not Bitcoin. There's a lot of fraud and bad stuff in crypto. A lot of gold people say, hey, I hate Bitcoin because it's Sam Bankman-Fried crypto. It's different, okay? Completely different. They're just not the same thing. Bitcoin's a technological innovation. It's a provable network that provides digital scarcity. There are only 21 million Bitcoin that will ever be issued, and that's a fact and won't change. There's technical risk associated with it. I talk about that in the book. I think it's relatively low, but it's not zero, which is why gold is a CDS on Bitcoin. Bitcoin is an emerging form of sound money. Gold has been sound money for 5,000 years, will continue to be, but Bitcoin is a digital format, a digital form of gold that's being adopted, and that's why it's outperforming gold. You know, everyone knows about gold. Everyone who wants to own gold already owns gold. Very few people, or a smaller percentage of the population, knows about Bitcoin, and they're coming to see that it has some inherent benefits. Let's talk about those. first inherent benefit is you can see it digitally on the chain, on the chain. It's available to everyone. It's triple entry accounting. You know how much Bitcoin is an address. We don't even know how much gold's in Fort Knox. They tell us what's there. We don't know if it's there. Second thing is it's very hard to move and translate, and transfer value in gold. I mean, you got to put it in, planes and trucks and drive it around and guard it and everything else. I can send you $1 billion. I don't have it, but I could send you $1 billion of Bitcoin in 10 minutes and it would be
Okay.
fully verified. You'd know I sent it. I know you have it. So,
Let's
um,
test that, by the way, afterwards. If you could send me that billion, that'd be
yeah,
great.
I'd be happy to send you something, but not $1 billion. So in my view, Bitcoin is going to be a very important technological form of money on a go-forward basis. And as the world comes to understand it and be less afraid of it, and there's a whole chapter in the book that my wife actually recommended called Skepticism, that talks about how new technologies, people are skeptical, and I get it. But I also believe that if they take the time to truly understand it and do all the work of understanding how the network functions, all the neat features of the network, like the halving and the difficulty adjustment, and a lot of other things that make it, in my view, very defensible, then they will come to where I've come to, which is it makes sense to have a meaningful position of your portion of your assets in Bitcoin. Now, don't get me wrong, it's extremely volatile, and that's the risk. How do people get hurt in Bitcoin? They buy at a top, and then it draws down 50 or 60%, and then they sell and they panic. So how does one deal with that? One deals with that by taking a modest, by allocating in the proper amount. If you put 4% of your portfolio into Bitcoin, it draws down 50%. You've lost 2% of your portfolio. Most people can handle that. And if the 4% goes up 10x, which I think it will over a decade, then the 4% becomes 40%, and you're glad you made the investment. So my view on Bitcoin is it's a volatile asset, but it has a lot of asymmetry on the upside.
Okay. Do you have a preferred recommendation on how to own it? Is it
I
own the
do.
coin yourself, keep it in a cold
I
wallet
do. I mean, for a
storage?
lot, yeah. So self-custody is owning the coin yourself. You can get a Trezor wallet or another hard wallet, and that's the absolute preferred way if you're afraid that the government might someday grab the ETFs, the way that Roosevelt grabbed the gold. But for most people, that's a bridge too far in terms of understanding the technology and coming up to speed. Although there are many people who can help you with that. For most people, the right entry period is a path is to get an ETF. I mean, when they approve the ETFs, I can now go into my Fidelity brokerage account and buy IBIT or FBTC or whatever. And Fidelity holds the keys. I don't have to worry about losing the keys or having them stolen. And I'm participating in the price appreciation of Bitcoin with whatever capital it is I have my Fidelity. And you can do this at Schwab or Morgan Stanley or wherever your brokerage account is. So that's kind of the easiest and fastest entry way, with the proviso that there's a risk there if the government ever decides to grab all the Bitcoin, that Fidelity and Schwab are gonna, they're gonna obey the law and give the Bitcoin to the government. And they're gonna give you cash. So and so for those of us who are super hardcore Bitcoiners, self-custody is preferred.
Okay. All right.
Yeah,
I'm going to start wrapping up in just a second, but let me ask you this question. I don't think I've ever asked this on air about Bitcoin, but we referenced the debate there in New
Peter. Yeah,
Orleans, and it was you versus Peter Schiff, and his joke about your Bitcoin tie was, Bitcoin's nothing, right? Here's the question. So gold is the universe's perfect money. That
yes,
we over thousands of years we've decided that. We looked at all the other elements that were out there in the universe and said, you know what, gold meets our standard for money better than everything else, right? And
right.
we're not creating, the universe isn't creating new elements on the periodic
Well,
table, right?
yeah, yep, it's in the Earth's
So
core.
so that's gold. Now, Bitcoin, one could argue, is the best money that humans can invent up until right now, right? We've
Correct.
said, you know what, this has some improvements on gold, and we think Bitcoin's awesome, right?
Can somebody
It's
do another one?
but
Yeah,
it's a code base, right? So
yeah.
tomorrow or a year from now or whatever, we might think, oh, you know what? There's actually one more improvement we just thought of, right? And since Bitcoin's a code base, right? Somebody could just copy the Bitcoin code, add that next improvement on it, and now it's a better version of money, but it's
What
Mitcoin
you
or
yeah,
Bitcoin,
what you're describing is a hard fork, and those have occurred. And basically, it is a code base, and basically somebody could come along and try and create a better form of Bitcoin. But this is where you get into the value of Metcalfe's law, which is that networks grow in value based on the number of users. And so a similar comparison would be to say somebody could come along today and create a better Google or create a better Amazon. And
Hmm.
you've got all those users and all the interactive touch points. And is it possible that it could happen? It's possible. Is it likely? I kind of don't think so. And the reason that I don't think so is that we're too deep into the whole thing where too many people have made their bet on this one thing.
So let me just make this comment. You can finish answering, but this is
Sure.
exactly the crux of my question, which is I totally get Metcalfe's law. I remember hearing it all the time when the internet was starting, and yes, there's these network effects are wicked powerful.
Yeah.
Um, but to a certain extent, what the argument sounds like to some people is, well, there's so much friction in moving from the existing system that we're just not going to do it. And so it's a way of saying we're going to stay with the less perfect option, right?
Yeah.
And if for money, should we stay with a less perfect option, or should money always be the more perfect option?
No, we should go to the more perfect option. And Adam, I would be the first if I ever saw something better than Bitcoin, okay, that got invented and was catching traction and was starting, and Bitcoiners saw it too, and was I would migrate. I mean, I'm always looking at what's going on. I mean, look, money is kind of it's kind of a shared illusion. It's what we all agree is
Right.
money. I mean, I mean, it really is. I mean, why is gold money? I mean, it's just a rock, you know what I mean? But we all agree that it's scarce and it's beautiful. It's used for, so, we all agree that Bitcoin right now is the absolute best technological form of money. And what you're describing is a better one could come along. And that is true. But let me say that Bitcoin's got one hell of a head start and a lot of network effect and billions of dollars invested in building the reusable proof of work network that secures that ledger. It is the most powerful and secure computer ledger. I was talking about this on another podcast. It really is the only thing. It's mathematical absolute truth, which is a little hard to get your head around, but it's the only thing, very much like a science experiment. It's the only thing we know. You know how math is by definition true. This is not a soft
Mhm.
science math, right? I mean, this is a digital ledger that is, recreated every 10 minutes and stored on thousands of places. So we know it to be true. Do you follow what I'm saying? And
I,
so
I do. I
so
do get
so
it.
so could there become a better one? Yeah. I mean, I'm open-minded to it.
Yeah,
I'm
especially in the
open-minded to it.
age of AI, where AI might start
I,
conceiving of
there's
things that
no
humans
doubt.
don't.
There's no
Yeah.
doubt. And I mean, if you talk to Lynn, who's brilliant about this, I mean, quantum computing, I mean, it's not risk-free. I mean, there are risks to this. And any investor who says they know something 100%, you immediately just throw them out as a quack because nobody knows anything 100%. We're all just groping around in the dark, trying to do our best, right?
So last question around this, and sorry to shove it in
No,
here,
it's
but
fine.
given our time constraints, I want to try to wrap this.
Fine. It's fine.
So is there a potential way to combine the 100% tangibility of gold with the additional benefits that you told us about Bitcoin, where rather
Well,
than not being backed by nothing, as Peter Schiff would say, it's a blockchain system like Bitcoin, but it actually ties to, atoms of worth
yeah,
of
there are people who've worked on this, like Kinesis Money, and there are others, and there are people working on this, and there are ways of putting gold kind of on a blockchain, and I think it's all kind of fine, but it's kind of like having a horse pull the car. I mean, the minute you do this, I mean, the beauty of the blockchain, the beauty of the Bitcoin network is that it's decentralized and it's fair to everybody, and nobody can control it. And so the minute you go in the direction that you're describing, you have to have some central party that's going to hold the gold.
who owns the gold has
Who
power
owns
in
the
this. I
gold
get
that
it. Yeah.
and they could rug you theoretically. I
Yeah.
mean, the beautiful thing about the blockchain, about Bitcoin is, bad actors could get involved in Bitcoin, but there's no way they can get advantage. They just can't, you can't cheat because of the mathematics of the system. You follow what I'm saying?
I
And,
got it.
and
Okay.
when you describe what you're describing, okay, but then we're back to the old system where we got to trust somebody. We got to trust the guy who issued the crypto tied to the gold that he really has the gold. See
Right.
what I'm
We got to
saying?
make sure the gold is there. Yeah,
Yeah,
exactly.
right. So it's a horse pulling a car. You might as well just drive the car.
Okay. All right, good. I get that answer. Okay, well, look, I'd so love to keep digging into this, but we don't have
Well,
time.
we can do another
We'll just
one.
have,
We can
we'll
definitely
just
do
have you
another one.
exactly. Just have you
Yeah, I
back
got to
on
hop
here.
on another one here, but all I would just say is please, if you can, read the book. I mean, I don't make much money on these.
So to that point, where can people get the book, Larry?
Yeah, so the book is on Amazon. You can get it hardback, paper cover, ebook, Kindle, and audio as well. Walker America reads it. It's 12 and a half hours. Somebody told me, hey, I listen to things at 2x, so it'll only take me 6 hours. I'm like, I don't know how you listen to things at 2x. I can't I can't absorb it at that speed. But and I say it, I think it's important. I'm on a mission. I'm on a mission to try and educate the country, the world, to why things are messed up the way they are, in my view, just one man's opinion, and it's a lack of sound money. And I think the book makes a good case for that. And if we can get enough people to understand that, I think we can accelerate the direction of the country towards sound money, which I think will make everyone's lives a lot better. Blue, red, doesn't matter where you are. I think all our lives will get a lot better when we get back to a sound money standard. So that's the message of the book.
All right. Well, Larry, I suspect you're going to have a lot of people cheering you on in that
I hope
here
so.
in the comments.
I
Thanks
hope
so much
so.
for appearing. Real quick, where else can people go to follow you and your work? And I know X is a
Just
big
so
platform, right?
as everyone knows, I'm active on Twitter at lawrencelepard.com. There's a book website called The Big Print Book, just thebigprintbook.com, which has a lot of information on it. It's going to get bigger over time. And then I run a couple of funds, and you can Google me, you'll find those. So, yeah.
Okay, great. So Larry, when I edit this, I'll put up the handles for that stuff there,
Oh,
but
that'd be
I'll
great.
also have
Thank
the
you.
links in the description below the video too.
Oh, yeah, yeah. Put up my website for EMA too, my business website, if you could.
Okay, will do.
Yeah, that'd be great.
All right. Well, Larry, look, it's been great. Congrats on the book, and we
Thank
look
you.
forward to having you back
Yeah,
on
I look
again
forward to
soon.
catching up with you again and seeing you. I'm sorry I got to hop.
All right. Well, now is the time of the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by John Lodra and Mike Preston. Gentlemen, great to see you. I am sure that there was a few moments in that interview there with Larry where you guys were nodding your heads extremely vigorously, given prior comments I've heard you guys make. But John, let's start with you. Let's talk about your takeaways from the interview here with Larry. And then the day we're recording this is Liberation Day. So the audience will know how that ends up. We're still awaiting the big news on tariffs here. So, we'll be prognosticating on a couple of topics that folks may actually have a little bit more detail on by the time this video airs, but we're going to do our best. So anyways, John, any feedback there on the interview with Larry?
Hi, Adam. Great to be with you. Always a great treat for us to hear from Larry. We've gotten to know Larry on a personal level. It's no coincidence. He's more or less right down the street from us here in Massachusetts, so we have that connection. But more to the kind of messages of his book and his talk with you. Yeah, he takes a big picture look at some really pressing and fundamental structural issues in our economy that are no small part the result of the intentional policy making that both from a fiscal and monetary standpoint that have distorted things like perhaps they'd never been distorted before. And he points to things like valuations and absolutely off the charts, and they have been for some time. And that hasn't mattered as much as historically those valuations in the stock market would, because there's been this kind of distortion of asset prices, at the heart of, kind of the devaluation of fiat currencies, or the debasement, or the, willful printing. What he describes here is a big picture roadmap that we think is critically important, not so much in the day-to-day portfolio decisions that clients should make or investors should make on their own behalf, but to really understand the bigger picture. Without a roadmap, you can get led astray really easy. And I think back to a very fond family vacation I had with my wife and kids and my parents back in Colorado, back probably 20 years ago now. And it was pre-GPS. I had a paper map, and I plotted us a nice loop, driving loop, in northwestern Colorado into Utah and southern Wyoming. And what I thought was going to be a 2.5 hour loop ended up being a 12 hour, actually kind of a scary episode, because we were in the middle of nowhere. And the reason is the scale of the maps for the different states were different as I flipped through the book. And I had no clue, right? So here we had a wonderful, peaceful, driving loop that got actually pretty dicey because we were running low on gas. There was no cell phone coverage. And, it just speaks analogously to the importance of a roadmap. Just like valuations are important to a roadmap, it doesn't mean they affect the markets in the very short term and the tactical decisions that investors should be making or that we make on behalf of our clients. But it's really important to understand the framework that defines the risks and rewards. And we've been longtime critics of much of the monetary policies that Larry talks about. That's why we've been so insistent or supportive of our clients having allocations to things like precious metals and precious metal mining, really at the heart of the sound money theme that Larry talked about. And it doesn't mean they go straight up. And Larry himself is as bullish as he is on those forms of sound money. Fully acknowledges, as do we, that there's every bit the possibility price can go down in a swift downdraft, and we use tools to help navigate that. And certainly, we oftentimes will adjust our positions and hedge positions and things like that. But the big picture framework that I think Larry lays out is really priceless, and we can't wait to read his book. And I'm sure there's gonna be a lot of great takeaways there. So that's my big picture reaction. The one other thing I'll just mention, I had the great privilege of being able to speak to a couple of business classes at Bentley University last week. We have a client who's a professor there, and she has me come every semester or so and talk to a couple of classes. And I took great joy or great fulfillment in sharing some, like, not joy would be the wrong word, because I shared some of these big picture charts that Larry talked about. I showed the class how the purchasing power of the US dollar has been eroded by 97%, over 97% since even just the 1940s, post World War II. I showed them how our debt has firmly surpassed our GDP. And this was an eye-opening experience for many of these kids. They're learning textbook business, but even to their relatively untested experience in the real world, it just didn't make sense to them. How could this be? How could we let this happen? And I guess the lesson here is that our policymakers seem not to want to look at the roadmap. They want to think about short-term political expediency, and it's no surprise we get to these kinds of probably intractable situations that there's no easy way out of. So that's big picture takeaway I have on that.
I appreciate that anecdote, and I was going to ask before you mentioned, what their reaction was to learning how much the purchasing power of the dollar had diminished. And some would say it's by design, some would say it's by neglect. But what we don't do is we don't teach financial literacy. We don't teach them basic things like how money is created or monetary history or things like that, right? So part of the reason why we get here is just kind of ignorance, right? Yeah, you're nodding. Folks can't hear your nodding, John.
Yeah, that's right, Adam. Sorry, I was fumbling for the mic button. Exactly right. And again, it's I think by design, because politicians and policymakers don't want to necessarily solve problems because it's so much easier politically to think about the short term.
Right, right. And it's so much easier, as Larry said, politicians will always prefer inflation because it allows them to keep kicking the can and doing what they want to do, right?
It is like it's like the silent killer to the populace, but it's an incredibly powerful tool for politicians and policymakers to have, because it gives them great power, great influence, but and the populace doesn't really realize they're being taken, if you will.
Yeah. Okay. So I think for a lot of people, they probably listen to Larry there and say, yeah, I get all this. This all makes a lot of sense. And then their brains go to, okay, so I've got to stock up on gold and I got to stock up on Bitcoin. I got to sell my stocks, right? And get out of bonds. And while that may be the winning playbook in the long run here, as I talked about with Larry, it could easily be a losing playbook for many different episodes between now and the final end game here. And the day that we're talking, as I mentioned, is Liberation Day. The world is awaiting clarity on the new Trump tariffs. And what's interesting is while the world has really taken the uncertainty around the tariffs as a negative, and the markets have sold off pretty heavily for the past month or so, you can get to a point where the markets are just so short-term oversold that they will snap back. And of course, if the Trump tariffs are not as draconian as maybe the average market participant has feared, that could create a big rally. The moment we're talking here, the S&P is actually up pretty substantially on the day, even though we don't have the clarity on the tariffs yet. And the reason why I mention all that is just you guys there at New Harbor, like all the investors watching this channel, you have to manage your money in the short term to get to the long term. So Mike, we'll get to you in a sec, but just sticking with you, John, for a moment. How are you guys doing that? Where you can look at the Larry stuff and say, yes, I think over the course of years, this is where it's headed, but I have to play the game that's in front of me to survive to get there.
Yeah, well, first and foremost, it starts with bringing it back to the reality of our client's situation. Whether they realize it or not, most realize it. Their job for themselves and our job on their behalf is not to hit the grand slams and calling the the breakout in Bitcoin if it's destined to happen, or even in gold if it's destined to happen with perfect precision and having a massive allocation to that. Yeah, great. Who doesn't want that if you had perfect vision and clarity? But the point is we don't. And it's not necessary to have that kind of grand slam winning call to create what clients need to create for themselves, or certainly our job to help them create. And that's financial stability, financial growth that can allow them to maintain their purchasing power, and that their assets can sustain hopefully at least their lifetime, so they can create their own paycheck, so to speak, during retirement. So it's really important to bring it back to what is the goal here. It's not to hit the grand slam. It's to live a fulfilling life enabled by one's financial resources, right? But there are some very practical and simple things. I mean, position sizing is one really important concept that is oftentimes overlooked. And Larry talked about it. He talked about it with Bitcoin, for example. He said, you don't, 2% position in Bitcoin. I'm not making any endorsement one way or another. I'm just using that as an example. You don't have to have all your eggs in one basket. In fact, it's very imprudent to. So even though we've been very bullish precious metals, for example, we have about a 10% allocation. Some clients want a slightly higher allocation to that, and we certainly can oblige them for that. But point being is there's no one tool, no one silver bullet, excuse the pun, for all the ranges of scenarios that we have before us and the economic and market outcomes that we have before us. So it's very important first to be open-eyed, to have that map to understand the landscape, and then make sure you've got everything covered so that no matter what happens, you're gonna achieve that financial goal that you have before you. And it doesn't need to be perfect, it just needs to be successful.
I like it. It doesn't need to be perfect, but it just needs to get you where you need to go. All right, Mike, coming over to you. Feel free to add anything on to what John said, but I just want to note the day we're talking, gold is hitting yet another all-time high. Bitcoin is actually catching a pretty big bid today too. You guys at New Harbor have had gold in your portfolio really ever since I've known you guys, which is saying something because that's definitely getting close to 15 years now. I know you held Bitcoin for a little bit. I think maybe you guys told us you sold out of that position, but if you could just clarify for folks right now what you guys at New Harbor are doing in terms of gold and in terms of Bitcoin.
We've been long-term believers in gold and gold mining stocks. And like John said just a minute ago, though, asset allocation or allocation percentage as a part of your portfolio is important. You've got to be able to survive the path that it takes to the ultimate destination. It would be very easy, and I've seen it happen many times, where you can get either thrown out of the position or you can get really hurt or just emotionally drained by being too over allocated. So we've got a 10% position in gold and precious metal miners, and we really kind of switch that percentage around based on which one's performing better. Right now, because of recent relative strength improvement in miners, we're fully 10% in mining stocks. We've got a lot of clients that are higher than that on their own, or in their own accounts, things like that. And some clients want more than 10%. We certainly accommodate that. And we talk to lots of people as well that aren't clients that are 100% in mining stocks and or gold. That's okay, to each their own. Our recommendation is to have an allocation that you can live with, because we'd like to be in it for the full move. We think it's important that you're exposed to the group. Get exposed to the overall group is more important than picking the exact right mining stocks. I know that Larry has a service and a fund that does pick individual stocks, but we here at New Harbor just get exposure mostly to the group through an exchange traded fund that buys a basket of those stocks. So, my takeaways, big picture, were that Larry was spot on in terms of the real bad thing about central banking has been the wealth inequality and the unfairness of it all. It's made us all grapple for, the concept of what is money and why is it not distributed equally? Why is it so unfair? The wealth inequality has been pretty insane the last 10 years, and it's only going to get worse probably as we approach the climax of this fourth turning. Larry talked about the fourth turning, and there's no doubt that we're approaching a climactic phase. The problem is that this fourth turning alone has been going on almost 20 years now, and this bull market in assets really took off in earnest in 1982, the last bear market low, and probably no surprise that that was about 10 or 11 years after we finally went off the gold standard. Who would have known that it would be 40 plus years before we really saw what's likely to be here, the blow off top in this entire move? I think that's what we're in now. And so that's a whole career or more. So it's important to know what the whole macro view is, but time goes slow often, and things happen slow until they happen all at once. And you never know where exactly you are in that cycle, so you've got to be prepared. So as John said, you've got to be aware where we are. And as Larry said, the charts are in his book. Valuations of assets are completely off the charts. You really have to make a decision about what type of exposure you want to have. Here at New Harbor, we're only about 40% stocks right now, and even that is hedged. Just below here, 15% of that is hedged. So we would very quickly be at 25% stocks. But we do think that gold and silver and miners are going to go higher. We've often talked on this program about gold going higher and that the next targets would be 3,200 to 3,400. I mean, we're right there right now. Silver charts are just starting to shape up, and we're just breaking out on silver, and next levels there would be 38 to 40 on silver. So why have the gold stocks not really broken out? They have broken out, and they have started to perform. We think there's going to be a little bit of a catch-up phase here. GDX should trade up near 50, and GDXJ maybe 65 in the near term if it does a little bit of catch-up. We've got some hedges on to make sure that we can keep in the position. So there's a lot to all of this because we just don't know where we're at, and as we climax, whatever happens, we do know it's going to be a difficult phase. The market should crash, maybe even collapse after all of this, climax happens. Gold and silver probably will even collapse a little bit, or at least some from that point. But we just don't know where we are in the story. Our sense is we got a little bit more to go, particularly in the mining stocks, and that's how we're positioned. Lastly, on Bitcoin, you asked about that. We did have a position in Bitcoin. It was very small, 1%. We did it through an exchange traded fund, and Larry mentioned ETFs that hold Bitcoin are very prolific and very available now. The charts are shaping up. There's been a pullback to support, and we might consider adding it back. But if we do, it's going to be relatively small. It'll be 1 to 2% again. Absolutely, we think that it is a real asset too. Bitcoin has proven itself. The charts look good. The blockchain is brilliant. We might buy it again, but it's not going to be a big piece.
Okay. All right. John, moving back to you just because we don't have too much time left. As I mentioned, today is Liberation Day. We don't have all the details yet on the new tariff policies or the new tariffs that are getting applied. But just any bits of parting thoughts about the uncertainty that's been created by the tariffs, and do you expect today to remove a lot of that uncertainty or just bring the next phase of uncertainty into the picture?
Well, I wish I did know, Adam, and the truth is I don't know because no one knows, right? Because what we have seen is an unfolding saga of uncertainty, and it's as uncertain as the next word or a policy statement that comes out. And of course, we won't know because we can't be inside the brain and minds of any one individual or collection of individuals. But absolutely, I think there's real evidence that the real economy and markets have taken to heart the uncertainty that this has unleashed. I had a conversation earlier today with a prospective client that happens to be in the auto sales industry. And ironically, well, not ironically, but predictably, it's a car company that is produced largely overseas, and therefore, in theory, is in the crosshairs in the tariffs that might be announced this afternoon or put into motion. But there's been a lot of front running, a lot of buying by the public to get in front of these potential tariffs. So we're seeing things like that across many different sectors. We had anecdotes, copper, for example, reached all-time highs, and we've seen anecdotes that global manufacturers and users of copper were basically stockpiling and kind of buying a bunch of copper in advance. So there's definitely been short-term economic and financial market outcomes that have been driven by this uncertainty. And it may be too simplistic, perhaps, if there is some certainty that comes through, and maybe that things come out to be more benign than the markets have expected. Maybe we see a snapback of some things in the other direction. Things that have been strong, pull off, and things that have been weak, get a spike. It's just too early to say. The point is, we don't have to know necessarily. We can see that in our charts and in what the market is telling us. Again, not with perfect precision or perfection, but with enough evidence to hopefully capture trends. I do want to, on the topic of that certainty, last couple of videos we've done with you, Adam, we've talked about the GDP Now forecast, which is a nowcast by the Atlanta Fed, and it just got updated most recently yesterday. And the reason I'm raising this again is because there was a big anomalous, there was a huge drop in this in late February, and much of that was attributable to imports of gold. Again, in theory, both as a flight to hard money, but also as a potential front running in case there were tariffs on importation of gold. And so the Atlanta Fed has come out with this adjusted for the gold, which is this one. But still, we're seeing some things start to turn down here. Now, again, I want to caution folks, this is not a forecast. This was what's called a nowcast. And basically, it gets updated every time there's a new economic release. So, it depends on what these data points come out as to what the ultimate reading is. But we're getting into the final stretches of this quarterly.
I was going to say, there's not that many more data points to be added.
There's not that many. Yeah, we got one tomorrow, international trade. But then you got a couple more. The final version of this is April 29th. So the runway is becoming less lengthy and there's less variables. So, at least initial readings appear to be showing that there is some at least temporary economic implications in terms of activity here that, we just got to take at face value and allow for that to happen. Ironically, today, as you mentioned, we're seeing the stock market spike pretty heartily, and the bond markets are selling off. Yields are spiking. That typically wouldn't happen if there's very strong concerns about growth. So it's a day by day headline driven market, and we just don't need to worry about things that closely. We'll see how things play out in a more trending sense. But yeah, no doubt about it. The people will be glued to the TVs and the airwaves come 4 o'clock today, I think is when that announcement is.
Okay. Well, we look forward to having you guys make sense of it all for us in next week's video with you. All right, Mike, we're wrapping up here. I want to give you the last word. Regular people are just trying to figure out how to navigate all this. What parting bits of advice do you have for them?
Well, just get safer. We've been saying it now for, it sounds like a few years, or it's been at least a few years. Get safe, get some gold and silver. Emotions are your enemy. We're happy to help with that. We've been hardened through experience and years and time. We know how to handle emotions. That's a big part of what we do, is help people just kind of slow down, take a breath, and not make mistakes. So if you're feeling overexposed, you probably are. If you're confused about how to get safer, give us a call or talk to your financial advisor if you have one. But we're happy to talk to you even if you're not our client. So, reach out to us and we'd be happy to do so. It's going to get rocky. Unfortunately, it makes us sound really dark and gloomy, but fourth turnings are hard. There's no way we're going to unroll this money printing system without some pain. It's just throughout thousands of years, as Larry said, politicians have used the departure from sound money every single time as a way to have more flexibility, political power, etc. I do think that there's
and it always ends poorly in the end.
Always ends poorly
For the currency holders, yeah.
Yeah, and we never know exactly when we're going to see a big turn, but it happens suddenly, and my sense is that it's soon, certainly within the next few years. So, before it's too late, if you're feeling overexposed, you're feeling anxious, just change, make some changes. You can always sit in money market funds for now, and a lot of people are doing that. The T-bill and chill at 4% still. So that's it. It's going to be a little scary. My sense is that it's going to be a difficult next few years. My sense is that the standard of living in the US might go down 20 or 30% permanently after all this is said and done. But, the bright side, it's going to be okay.
Man, Mike,
Um,
people are thinking my standard of living just went down 20 or 30% post-COVID with all the cost of living increases. You're telling me I'm going to get that hit with that again?
Yeah, I'm afraid so. I'm afraid so, but it's going to be okay. There's going to be opportunities after a fourth turning is a first turning, all kinds of different opportunities. You just have to keep a positive attitude and, be able to take advantage of them. But if you're
Well, and
stuck emotionally, it's going to be hard to do it.
yeah, and to be on the right side of that, you got to navigate your wealth intelligently through this process. So as you said, Mike, you guys, are very kindly willing to talk with anybody to try to help them think through their best steps, whether they become a client of yours or not. So folks, if you don't already have a good financial advisor who's helping you navigate through all this, take into account everything that Larry and I talked about, then highly recommend that you consider talking to one of the financial advisory firms endorsed by Thoughtful Money, perhaps even John and Mike and their team there at New Harbor. To set up one of those free consultations, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There are no commitments, as Mike said. It's just a free public service that these firms offer. Mike, you mentioned the fourth turning several times. I think, John, you mentioned it too. I'm just letting folks know that Neil Howe, the demographer who coined the term the fourth turning, or co-coined it with his partner who's no longer with us, is going to be coming on this channel on, I think right now he's scheduled to come on May 6th. So we'll be hearing from Neil again relatively soon, folks. So hopefully that's exciting for you. Also, because gold was mentioned so much, if you're thinking about owning gold, but you don't understand all the different options or you're new to it, feel free to download our free buying and storing gold and silver. To go get that, you can just get it at thoughtfulmoney.com/gold. All right, gentlemen, thanks so much for being here for yet another week. Great job today. Look forward to seeing you guys next week and making sense of all these new tariffs for us.
Thanks, Adam. Great to be with you. We'll see you next week.
Thank you, Adam, and see you next week.
All right, and everybody else, thanks so much for watching.